Most of the dollar's declines took place in the first half of the year, a bit more stability in the second half. Do you expect that to continue? We kind of laid out those key drivers, and it seems like none of those big headwinds have really gone away necessarily. But do you expect this kind of stability that we've seen over the last 6 months or so to carry through into 2026?
Yeah, that's our view, that we think that, like you say, the fundamentals which have driven the dollar weaker in 2025, like heightened US policy uncertainty under the Trump administration, and also the Fed resuming their rate cut cycle. Both of those factors we still think are in play in 2026. And it's our view that we think over time we will see euro dollar drifting back above the 120 level. But like you say, maybe in the first half of the year, the risks are that the dollar may continue to consolidate at these weaker levels. Like the Fed have indicated at the December meeting that they do appear to have a preference to at least pause the rate cut cycle at the start of this year, maybe skipping the January meeting. But we still have confidence that if the labor market remains weak, as we expect, that the Fed will deliver at least 2 or 3 more cuts in 2026. So if the Fed is still active in terms of cutting rates when other major central banks like the ECB appear more likely to keep rates on hold this year, that yield differential should continue to move in favor of a weaker dollar in 2026.
Coming into the year, there was obviously a lot of concern surrounding potential flashpoints on the policy front, potential shocks to the market from tariffs or immigration or just kind of deregulation and trying to figure out what that all means. A lot of that obviously happened in 2025, and the equity markets did fine. Obviously, the dollar dipped lower. So how concerned are you about the potential for more of those in 2026, since we got a lot of them out of the way this past year?
Yeah, like you said, I think we did see kind of financial market volatility peaking back in April last year after Trump's Liberation Day tariff announcement. And since then, we've seen volatility dropping back to year-to-date lows at the end of last year. So we're kind of entering 2026 with volatility at very low levels, which is supportive for risk-taking from investors. So that is kind of encouraging investors to go in taking on more risk. So in the FX market, that's certainly supportive of carry strategies. So the kind of higher yielding currencies, particularly emerging market ones like Brazilian real and the like, have done well, and we think can continue to do well at the start of this year. That's not to say, though, that all of the negative shocks are out of the way. Obviously, from a US policy perspective, there is still the risks there or threats to the Fed's independence when Trump chooses his new Fed chair, and then we'll have to see, obviously, what that new Fed chair does in terms of changing the Fed's policy reaction function in the second half of this year. So for us, that's the big downside risk for the dollar. Like it's not our base case scenario that the new Fed chair will put in place a much faster pace of rate cuts, but that there is a risk there that if that does materialize, we could see the dollar weaken even more sharply than we're anticipating.
No, it's a good point. And it really feels like the FX story, at least toward the end of 2025, and I'm expecting that to continue this year, is the yen. There are new reports over the holiday that businesses in Japan are urging the government to address its weakness, the yen's weakness, which, of course, is inflating import costs and weighing on households and businesses there. What's your take on the move in the yen, and do you expect to see any kind of intervention from Tokyo?
Yeah, like we think the risk of intervention is now very high based on the recent comments from Japanese officials. They've raised the level of verbal intervention to a high level, which in the past has been kind of consistent with them eventually following through and intervening in the FX market to support the yen. So we are kind of getting closer to that point of intervention. And a couple of fundamental factors are kind of contributing to that as well. Like you say, at the end of last year, we did see the yen continue to remain at very weak levels, even though the BOJ moved to hike rates and to signal further rate hikes in the coming year, while the Fed was cutting rates. So normally when that policy differential between the US and the Japan narrows, you would expect dollar yen to move lower. But the fact that it's still trading at close to the highs from last year tells you that it's kind of broken away from the normal kind of fundamental drivers, which could give justification for Japan to intervene. And if you look as well at the latest positioning data in terms of speculative positioning held by leverage funds, we can see in December that those short yen positions jumped sharply to the highest levels since back in June, July of 2024, which was also the last time that Japan intervened to support the yen. So I think there are grounds there for them to intervene in terms of it seems to have kind of broken away or diverged from fundamental drivers, and speculative short yen positions are also very high right now. So a number of reasons there for them to intervene.